Did you know that the stock market has been around for over 400 years? It all started in Amsterdam in 1602 when the Dutch East India Company became the first publicly traded company. Fast forward to today, and the stock market is worth over $100 trillion worldwide. That's right, trillions of dollars changing hands every single day. But here's the shocking part. More than 90% of people who try to invest in the stock market end up losing money. Why? Because they don't understand how the market really works. In this video, we're going to break down the mysteries of the stock market and show you how to take advantage of the opportunities it offers. We'll explore how stocks work, what exchanges do, how IPOs can make or break an investor, and why market sentiment can be your biggest enemy. We'll also dive into strategies used by legendary investors like Warren Buffett and how you can apply them to your own investments. Are you ready to unlock the secrets of the stock market? Stick around. This journey could change the way you think about investing forever. Chapter 1. Unlocking the mystery. What makes stocks tick? If you've ever wondered how stocks actually work, you're not alone. Stocks represent ownership in a company, and that ownership can increase in value over time. But here's where it gets interesting. Stock prices don't always reflect the real value of the company. They can fluctuate wildly due to market sentiment, news, and even rumors. This makes understanding the true value of a company essential for investors, especially value investors. One key strategy is learning how to assess a stock's intrinsic value. Intrinsic value is essentially the true worth of a company, determined by its fundamentals, earnings, assets, liabilities, and growth potential. Think of it like buying a used car. If you know its real condition and market value, you can decide whether it's worth the price. Stocks work the same way. Value investors, like Warren Buffett, often emphasize looking at a company's financials before making an investment decision. You want to know how much cash the company has, how much debt it carries, and whether it's generating consistent profits. Buffett once said, "It's far better to buy a wonderful company at a fair price than a fair company at a wonderful price." This approach helps investors avoid overpaying for stocks. Another important aspect is the price-to-earnings (P/E) ratio, which tells you how much investors are willing to pay for a company's earnings. A low P/E might signal that a stock is undervalued, but it's important to consider the company's growth potential. Sometimes a low P/E means the market sees trouble ahead. While most people chase after rising stock prices, value investors prefer looking for stocks that are priced below their intrinsic value. This is where patience becomes crucial. Stocks can stay undervalued for a long time, but with the right strategy, they eventually catch up to their true value. One study found that companies with low P/E ratios outperform those with high P/E ratios in the long run. In short, value investing is about identifying stocks that are priced lower than their true worth and holding onto them until the market catches up. Remember, investing isn't about getting rich overnight. It's about finding quality companies at a price you can afford. Chapter 2. Exchanges exposed. The hidden powerhouses of the market. Stock exchanges are the beating heart of the financial world. They're where buyers and sellers come together to trade stocks, but how much do you really know about them? The New York Stock Exchange, NYSE, and Nasdaq are the two biggest players, but they function very differently. The NYSE is a physical exchange, where brokers still gather in person to buy and sell stocks. It's the oldest stock exchange in the world, founded in 1792. On the other hand, Nasdaq operates completely electronically, which has made it the go-to platform for tech companies like Apple, Amazon, and Microsoft. For investors, understanding how exchanges work is crucial. Stock exchanges provide liquidity, meaning you can buy or sell stocks quickly and easily. But liquidity also means that prices can change fast. This is where value investors need to stay calm and focused. Exchanges allow prices to fluctuate, but that doesn't always reflect the true value of a company. A value investor looks at the long-term picture, not short-term movements. Another key point is the concept of market makers. These are firms that help facilitate trades by offering to buy or sell stocks at any time. Market makers play a huge role in maintaining market stability, ensuring that buyers and sellers can always find a match. Without them, exchanges could get chaotic. If you're aiming to be a successful value investor, it's important to understand how stocks move in the market. Prices go up and down because of supply and demand, but also because of news, earnings reports, and broader economic conditions. Often, the market overreacts to short-term events, creating opportunities for value investors to snap up stocks at a bargain price. Take the example of the 2008 financial crisis. During that time, stocks plummeted, but many companies were still fundamentally strong. Investors who understood the long-term value of those companies made massive gains once the market recovered. The lesson here? Don't get caught up in the chaos. Stay focused on the fundamentals and remember that stock exchanges are just platforms for buying and selling, not reflections of a company's true worth. Chapter 3. The IPO journey. From private to public, a hidden gem or a trap? An IPO, or initial public offering, is when a company goes public by selling shares of stock for the first time. This is a big moment for any company, but for investors, it's a chance to get in on the ground floor. But should you buy into an IPO, or is it best to wait and see? The truth is, IPOs can be both a hidden gem and a potential trap. One of the main strategies for value investors is to look beyond the hype. Many people get excited about IPOs because they think they'll make a quick profit. The reality, though, is that IPOs are often priced high due to the excitement surrounding the company. This is where value investors step in with a more cautious approach. A classic example is Facebook's IPO in 2012. The company had massive potential, but its IPO was priced too high, causing the stock to drop shortly after its debut. It took several years for Facebook's stock to reach its true value. For value investors, this was a clear lesson. Never chase an IPO just because it's popular. The price needs to reflect the company's actual worth. Before investing in an IPO, it's important to assess the company's financial health. Does the company have strong earnings, a good track record, and a clear plan for growth? For example, when Google went public in 2004, its IPO price was considered reasonable based on its earnings potential. Investors who got in early reaped huge rewards, as the company's stock price skyrocketed over time. Another strategy for value investors is to look for companies with long-term growth prospects. IPOs can be a great opportunity to buy into a company that will grow over decades. But you need to be patient. Don't expect immediate returns. As Peter Lynch famously said, the key to making money in stocks is not to get scared out of them. To sum up, IPOs can offer value, but they also come with risks. A smart value investor focuses on the fundamentals, looking for companies that are undervalued or priced correctly, not just jumping into every new offering. Patience and research are your best allies in navigating the IPO world, and over time, they'll help you spot the true gems. If you're finding these tips helpful, make sure to subscribe to our channel for more insights on value investing and how you can make smarter investment decisions. Chapter 4. Beneath the surface. How market sentiment can fool you in the stock market. Emotions often drive prices more than actual company performance. This is what we call market sentiment, the mood of investors, whether they're feeling optimistic or fearful. And often, it leads people to make irrational decisions. The key to successful value investing is learning to ignore these emotional swings and focus on a company's fundamentals instead. Market sentiment can create bubbles, where stock prices skyrocket based on hype, rather than the true worth of a company. A famous example is the dot-com bubble of the late 1990s. Investors rushed to buy up shares of internet companies, many of which had no solid business model. When the bubble burst, many lost huge amounts of money, but value investors who stayed grounded and focused on actual company performance were able to avoid the damage. One way to stay calm in a market of emotional extremes is to keep a long-term perspective. The market can swing wildly in the short term, but over the years, stocks tend to reflect a company's true value. Warren Buffett says it best: the stock market is a device for transferring money from the impatient to the patient. It's also important to recognize that sometimes, fear can lead to opportunities. During times of market panic, stocks often fall to prices that are well below their intrinsic value. This can be an ideal time for a value investor to scoop up undervalued companies. Take the 2008 financial crisis, for example. While many were selling off stocks in fear, value investors like Buffett were buying up bargains like Goldman Sachs and Bank of America. The challenge is recognizing when market sentiment is irrational. Often, it's clear when investors are panicking or overly enthusiastic. Value investors use tools like earnings reports and financial statements to separate emotion from fact. By doing so, they avoid the temptation to buy high out of excitement or sell low out of fear. In the end, the market is often a reflection of human emotion. But for those who can stay rational, it provides countless opportunities to buy solid companies at a discount. Remember, patience and discipline will always outperform short-term emotional decisions in the long run. Chapter 5. The Art of Valuation. Turning numbers into investment gold. Valuing stocks is a skill that separates value investors from the crowd. It's not about guessing which stock will go up next, it's about calculating the true worth of a company and determining whether its stock price reflects that value. The art of stock valuation can be complex, but with the right tools, anyone can do it. The most common method for valuing a stock is the price-to-earnings (P/E) ratio. This ratio compares the price of a stock to its earnings, helping investors determine if a stock is overvalued or undervalued. For example, if a company has a P/E ratio of 15, it means investors are willing to pay 15 times the company's earnings per share. Generally, a lower P/E ratio suggests that a stock is undervalued, but it's important to compare it with other companies in the same industry. Another powerful method is discounted cash flow (DCF) analysis. This technique takes into account the future cash flows of a business and discounts them back to the present value. The idea is to calculate how much future earnings are worth today. While this method requires some projections, it gives a more accurate picture of a company's potential than simply relying on current earnings. But valuation isn't just about the numbers, it's also about understanding the company's business model and growth prospects. For instance, Apple's stock might be more expensive compared to others, but its consistent innovation and strong brand provide significant long-term value. A value investor looks for businesses that have a competitive edge, low debt, and solid earnings growth. One essential factor to consider is the company's balance sheet. This will tell you how much debt the company has compared to its equity. Companies with too much debt are riskier, especially if interest rates rise. A good rule of thumb is to invest in companies with low debt-to-equity ratios, as they tend to weather economic downturns better. In addition to the P/E ratio and DCF, investors should also look at return on equity, ROE. ROE measures how efficiently a company uses its equity to generate profits. A high ROE indicates that a company is effectively turning equity into earnings, which is a sign of a strong, well-managed business. Using these strategies, you can confidently value companies and find stocks that are priced lower than their true worth. The key is to focus on the numbers, not the market noise. By valuing companies based on their fundamentals, you'll be in a better position to make sound investment decisions. Chapter 6. The Long Game. Why patience and persistence lead to stock market wealth. In the world of investing, patience is more than just a virtue, it's a strategy. Many investors make the mistake of chasing short-term gains, trying to time the market, or reacting to every piece of news. But value investing is all about the long game. It's about finding solid companies, buying them at a reasonable price, and holding them until their value is recognized by the market. Warren Buffett, one of the most successful value investors of all time, is known for saying, "Our favorite holding period is forever." He believes that the best investments are those that you can hold for the long term, allowing your money to grow steadily over time. Rather than constantly buying and selling, Buffett looks for companies that have strong growth potential and a solid foundation. The power of long-term investing lies in compounding. When you invest in a company that consistently grows its earnings and reinvests its profits, you get the benefit of compounding returns. Over time, this can lead to exponential growth. In fact, the average annual return of the stock market over the past century has been about 7% after inflation. While this doesn't sound like a huge number, the power of compounding makes it incredibly effective in the long run. Another reason patience is important is that stock prices don't always reflect the true value of a company in the short term. Sometimes, market sentiment can create volatility, causing stock prices to rise and fall. But if the company's fundamentals are strong, the price will eventually catch up to the intrinsic value. That's why holding stocks for the long term can yield far greater returns than trying to play the market in the short run. It's also important to avoid the temptation to sell just because a stock has dropped in price. As long as the company's fundamentals remain strong, short-term price fluctuations should not affect your long-term strategy. Remember the story of Coca-Cola, which faced significant challenges in the 1980s but rebounded to become one of the most successful companies in the world. Investors who held onto their shares reaped massive rewards. In conclusion, the key to success in value investing is time. Patience and persistence are what separate the amateurs from the true investors. By focusing on solid companies and holding them for the long term, you allow your investments to grow, compound, and eventually reach their full potential. As the saying goes, the best time to plant a tree was 20 years ago. The second best time is now. Don't forget to subscribe and hit the bell icon for more valuable insights into value investing. Stay informed, stay patient, and let your wealth grow.